Hi there, welcome to the Ecofina Financial Channel. My name is Philip, and as usual, I'll be discussing something very important about the economy and finance. Today, our focus is on nothing else but on cryptocurrencies. So today, I found it very important to just discuss generally about what cryptocurrencies are and why you have to be careful before making that commitment to invest in it. Because it's always good to be able to weigh the risk and return of every investment before you put your money into it. So today we'll look at it a bit in detail, just so that you get an understanding of how it works and on why you need to, be a bit cautious when you are making that investment. And now, just to talk about it generally, when it comes to the world of investments, there are several assets. You hear about equities, you hear about fixed income, you hear about private equity, venture capital, hedge funds. There are a lot of them. And then, of course, but within it all, not every investment is suitable for everyone. I think that's the first thing that is important to note. Even though equities might work for some, bonds might work for some, and generally equities and bonds are what most people invest in. But the truth is that every professional investor would tell you that you have to know what your risk tolerance is and assess your appetite before you invest in anything, which is why that's the perspective we are going to take as we evaluate cryptocurrencies today. Investopedia defines cryptocurrency as a virtual currency that is secured by cryptography, which makes it nearly impossible to counterfeit or double spend. Now, that's what it is generally. But what major thing that cryptos are known for is that they are not controlled by governments. And that reason is also one reason why many people like it, believing that something that is not under the control of government is good. It's not necessarily the case. Sometimes, and especially because you have no control over other people, you need a form of, standardized organization, be it governments or other bodies which are strong and reliable to manage or to indeed put corporations under check. So if something is going to be running on its own, there's also a higher risk, because then even if they misbehave, you probably do not have the capacity to sanction them. But a government authority would normally be able to do that. So when you're talking about, there's a lot of freedom when it comes to investing in cryptocurrency, you have to measure what kind of freedom it is. It's true, like I said earlier, that there's no general rule to invest in, but you have to know what your risk tolerance is. Not everybody's risk tolerance can take investment in cryptocurrency. Why? Because, cryptocurrencies actually, they move on the basis of how some people feel, really. And the movement of cryptocurrencies is usually based on, there will be more buyers than there are sellers. And when there's more demand than supply, what happens is that prices go up. And that's the foundation upon which the cryptocurrency actually moves. Now, it's not based on economic fundamentals, which you can say that, right now, people love to buy maybe a certain product, Apple iPhones. And you can see clearly that people will go to the market and do whatever it is to buy it. Now, that has an effect on how the Apple, for instance, is going to grow. It means that they are going to sell more, they are going to make more money, and the growth of their business is, guaranteed to a large extent. But it's not the same when it comes to cryptocurrencies. It's based on, there will always be more people wanting to buy than there are sellers. So which is why you have to be very careful when you're investing in such an asset. So the advice is that the cryptocurrency market is very volatile. And it's only those who have a very high risk tolerance that should actually be involved in it, if at all. But if you must be also involved, even if you have a high risk tolerance, then limit the portion of your portfolio you put in cryptocurrency. It shouldn't be that you put 80%, 70% of your entire investment in cryptocurrency. It's too risky. It can turn a millionaire into an ordinary person overnight. because it's very volatile. And like I said, because they are not governed by fundamentals. There are several things that that you have to consider. You might say, oh, okay, stocks are also going down, but you know why they are going down. You know why the inflationary pressures and how demand and all those things are affecting those ones. It's not the same. It's not as predictable when it comes to cryptocurrency. Somebody just sits in his home and tweets about something, about what he feels, and then you see the market moving as much. You have to be careful. You have to know if you are really involved in the right assets. If you have questions about cryptocurrency that you think you would like us to answer, feel free to share them in the comment section. We would be glad to answer them. But note that what we say is that if you don't have a high risk tolerance, you know that you don't have the portfolio, you don't have much that you can afford to lose, then maybe you should stay clear of cryptocurrencies. So that's it on this edition. We'll be back with you next time.